Okay, everybody, this is the not income, investing and savings unit of JA Finance Park. I do want to bring your attention to the fact that in the income unit, I was using an older book, which is why some of my pages were off, but also the extension activities. So you see some of the pages say extension activity. If they say that, then we will not cover those in these videos. But they are really cool things to do and look at in order to get a sense of finance and what you want to do for your career. So we can look at them over the course of the year, but in order to get us ready for JA Finance Park, we are going to focus on the essential things that do not say extension activities. All right, so if it's covered in the video, you need to know it. It will be on the assessment that I will give you. All right, so let's talk about savings, investing, and risk management. Get out your yellow highlighter and get ready to highlight. Let's see if I have a highlighter in my annotation tool. I do. All right, very good. Okay, let's see. Look at that. Okay, so I'm going to read. Saving only occurs when you choose not to spend all your income. That is so true. It can be difficult as you grow. To avoid the temptation to overspend, you need to learn to pay yourself first, which means automatically to save a portion of your income for future use. Okay. So where should your hard-earned savings go? A financial institution such as a bank, credit union, savings and loan, or investment firm helps people save for the future with simple savings accounts and more complex investments. Simple savings accounts. And there are, okay. Putting money into a savings account is a safe way to save money. Savings accounts, however, offer low interest rates. There are many ways to invest to earn higher rates of return. So we're going to higher rates of return. Three common long-term investment types are stocks, mutual funds, and bonds. They allow savers to invest their principal and earn over time a higher rate of return than the money placed in more conservative savings accounts. But stocks and mutual funds are not guaranteed investments. Investors can lose part or all of their money. The value of bonds can erode, go down, if interest rates rise. And students, like investors, must learn to gauge risk when they decide how to make their savings work for them. The opportunity cost of starting a savings program with income from a summer job may seem challenging. And for those who choose to save, the number of options can be overwhelming. This lesson will introduce you to various methods of saving, such as savings accounts, stocks, and mutual funds. So when I taught this in my math class, I found a lot of students were saying, I'll put my money in a savings account and the money will go up, but that's really doesn't happen. Savings accounts, your money kind of stays where it is for the most part. And so in order to earn more with your investment, you want to know about these different things right here. So let's read about it. A bond is an IOU issued by a company in exchange for a loan from an investor that will be repaid. So it's like they need $10,000 to build something, so they offer bonds of $1,000, and then you give them $1,000. 10 people give them $1,000, and they have $10,000. And then they say, we'll pay each one of you back $1,000 plus an extra $100. So then they actually end up paying back $11,000, but they don't have to do so until maybe 5 years later when they've already been able to earn much more than that. So it's a win-win. Opportunity cost is the next best alternative given up when making a financial choice. So if you do something, then you can't do something else. So if you invest your money in a bond, then you can't also take that same money and invest in a stock. So you have to think about it like that. But you might want to invest in bonds over stocks because stocks are more risky, but they also will give you more money if it works out. Pay yourself first. We talked about that. Principal. Let's highlight this. Principal is the amount that you initially put in. So it could be $1,000 or whatever it is. And then the interest is what you get in addition to that over time. Risk is the possibility you'll lose your investment. And savings account, we talked about that. Stocks. Oh, so we talked about bonds. A stock is a share of a corporation sold to the public. Stock is very interesting because if you own stock in a company, then you are a part owner of that company. And the people in charge of the company that are running it are called the board of directors, but they have to answer to the shareholders. So people who hold the stock are the actual owners of the company. Even though they don't run the company, they are influential in decisions made. And a mutual fund is a safer way to invest in stocks. It's where people have collected a bunch of stocks for you and created a fund that you can put your money into. It's a bit safer than one stock, because if one stock goes bad, then you lose all your money. So you might want to do a mutual fund. And then if one stock goes bad, you still have the others in the fund, then it might be successful. All right, let's read these, and then you're going to have to take some notes on them. So the percentage of teens who say they haven't done enough research about paying for college. Look at that, 75% of high school juniors are just about to go there. 62% of seniors and 64% of college freshmen. So they're there and they didn't do their research. And that's more than half the country. So do your research right now and you'll be way ahead of the game. And it's not hard. Teens who say they do not feel prepared to pay for or manage the cost of college. 52% of juniors, 39% of seniors, and 34% are there and they don't feel prepared. Teens who have less than $1,000 saved for college. There you go. Percent of teens who say parents have spoken to them only once or not at all about paying for college. Wow. So make sure you have these crucial conversations so that time goes by and you are ready. So go ahead and write down 2 things that stick out to you and how you can make sure that you are not in this bad situation. How you can be proactive when it comes to saving for college. All right, let's do doodles for dollars. What are your goals? Do you want to live on your own someday? You don't want to live with your mom the whole life there? Go to college. How much money do you think you'll need? Create a graphic organizer to show what saving looks like for you. Start by writing your savings goal in the center, right here, how much you want. And to begin, shade in the bar graph to show the money you'll receive each month. If you don't receive a regular amount, use $50. Okay, so then we're just gonna take in, if you earn $20 from your parents, then you'll shade this like that. And if you work and you earn $50, then you can shade that, and so on, and gifts and babysitting. And this is per month, so think about that. Make a pie chart to show how you spend money each month. Pie chart. How much money do you spend on music, eating out, movies, clothes, video games, right? So there's 25%, just for example. Here is another, whoa, You can do another 25%. Do you know what happens when we split 25% in half? We get 12.5%. Possibly that could be, oops, no, that's 12.5. This is just an example. Yours does not have to look exactly like this, but think about the percentage of how much you spend. Do you spend money? Do you guys really? Pay yourself first. Show how you can save more money, even if it's just $1 or $2. And where will you keep your money? So just go ahead and write that right here. What are you saving for? And then right in the middle, write what you're saving for. Are you saving for a PS 75 or whatever they're on? No. Okay, and now we are going to do a little bit of reading here about the different investment instruments, and then you're going to fill out this tweet. Okay, you ready? Know-it-all savings cards. Savings accounts carry low risk because most bank and credit union accounts are insured by the government, the FDIC, for up to $250,000 per account. So what that means is if you have $10,000 in the account and the bank has to close because of things that you didn't have to do, then the federal government will still make sure you get your $10,000, all the way up to if you have $250,000 in the account. They'll make sure that you have that money. Savings accounts pay a small interest rate, less than what stocks or mutual funds yield. Okay, but you can take your funds out at any time without penalty. Banks also offer certificates of deposit, which are safe and offer slightly higher interest rates than savings accounts, but they're not that great. CDs often require you commit larger amounts of money for longer periods of time. Keep in mind, minimum deposits and fees may apply. Early CD withdrawal may incur penalties. The interest earned on savings account and CDs is lower than the potential interest on other investments carry more risk. So above this, either write down in your own words what it's talking about, or a question you have, or something you didn't understand. And then ask about it. Now let's move on to money market accounts, and we'll do the same thing. Money market accounts are interest-earning accounts offered by FDIC-insured financial institutions. Money market accounts usually pay a higher interest rate than savings accounts in exchange for a larger deposit. Accounts may come with a check writing privilege. Keep in mind, minimum deposits and fees may apply. Federal regulation limits certain types of withdrawals and transfers from money market accounts to a total of 6 per month statement period. So money market accounts, you can still, it's like a savings account, but you can only take out money so many times. And you know why? Because when you put money into these accounts, they are doing things with it. And if you put money into a savings account, they are using it to create loans for other people. And money markets account, they're actually putting it into the stock market. So you can still take it out, but they limit you to 6 times so that they can do what they need to do. All right, bonds. A bond is essentially an IOU. We said that if the issuer promises to pay the bond buyer a certain sum of money at the end of a stated period, plus interest payments at specific intervals or when the bond matures. A bond fund pools money from many investors. Unlike stocks, bonds do not represent ownership in the corporation, government agency, or utility borrowing the money. Keep in mind, unlike bank savings accounts, bonds are not insured. Bond buyers could lose some or all of their money, but this is less likely than with stocks. Cashing in before the maturity date could result in the loss of principal, the amount bondholders put in. Bond funds are subject to the rise and fall of interest rates. Know-it-all savings card. Stocks. Stocks represent a fractional ownership in a company. Traditionally, they pay higher average returns than most any other investment. Stocks are sold in shares and their price can change daily. They are long-term investments because they are meant to gain value over a longer period of time. Although they can be bought and sold anytime based on their company's performance. Some companies pay dividends to stockholders based on the company's profits. Keep in mind, stock markets go up and down. Stocks are not insured for loss, so stockholders could lose their principal, the amount they put in, and any return. And return is the amount extra that you get by your investing. And the last one, mutual funds. A mutual fund is a professionally managed investment with money pooled from shareholders plus interest earned to buy a collection of stocks or bonds of various corporations. Each investor buys shares of the fund that represent partial ownership of the fund's collective holdings. A mutual fund's goals are explained in the fund's published report called a prospectus. I didn't know that. Shareholders can elect to take the money earned, paid as dividends, or reinvest it to buy more shares. Keep in mind, as the stocks money invested in mutual funds is not insured, mutual funds can lose value in stock market swings. Fund objectives and fees vary by fund. So there you go. You've learned much more than the average 7th grader knows about financial instruments. And now go ahead and look over the savings options, briefly summarize its benefits and risks in a 280-character message and print it below. So pick one of the investment instruments and tweet about it right here. And then it's time to go on to investment lesson 2, but guess what? It's only one page. Are you ready? Here we go. Accidents, sickness, weather disasters, and emergencies happen even to the best prepared. Minimizing risk is the main reason people buy insurance policies. Insurance policies are legal contracts between companies and insurers that safeguard assets by providing financial compensation in the event of a significant accident, needed medical care, or unfortunate circumstances. Insurance can protect individuals and families from unforeseeable health expenses or loss of income, provide money and housing if a home is damaged or destroyed by fire, theft, floods, and other hazards, safeguard savings if the family car is stolen or from accidents and injury. If you're old enough to drive, you or your parents may pay an annual fee or premium for auto insurance. With most insurance, if a policyholder makes a claim, he or she must pay a deductible before insurance covers the remaining costs. Health insurers often ask policyholders to pay a portion of their medical costs with a copay in addition to their deductible. Did you know? Before determining auto rates, insurance companies will want to know the type of car to be covered, including the make, model, and age of the car, who will be driving, the person's age and driving record, and how the car will be used. First-time drivers may need to provide a recent report card as well. Wow. For many types of insurance, premiums are determined by a person's age, health, life habits, and sometimes where they live. So I just want to summarize that. You can put this in your notes as well. Insurance is something you pay for every month or maybe, every half a year, depending on the agreement you make with the insurance company. And then when the actual event happens, you don't have to pay the full amount if it happens. And these are things like health costs. When you go to the doctor, those are really expensive visits, but you pay for health insurance so you don't have to pay the full bill. Possibly because you pay for the health insurance, they pay $300 and you pay $25. So it's a good thing. Auto insurance. if your car gets stolen, you can report that to your insurance company, or even if you get in an accident, and they will give you a big check so you can go get a new car because you have auto insurance. Also, if your house burns down in a fire, the insurance company, if you have homeowners insurance, will give you a check so that you can go buy a new house. So insurance is pretty important, and even if you think these things could never happen to you, having insurance will make sure that if they ever do, you are okay. And so that's another type of investment that we have to think about, insurance. All right, so that concludes the investment material for JA Finance Park. Please make sure that you complete this notes section with takeaways about insurance, and you will be all set for our investment assessment.